Welcome to the deep dive. You've given us some fantastic sources on automatic data processing, Inc., ADP.
Right.
Yes.
Yeah, that was the one. ADP.
Our mission today is basically to unpack what makes this company tick. We'll look at its business, its defenses, and maybe some surprising vulnerabilities, too. It's your shortcut to really getting ADP.
Yeah, and it's a fascinating company. I mean, it touches so much of the economy, but most people don't really grasp how it works underneath. The sources you provided give us an incredible amount of detail, almost like a full investment analysis.
Exactly. And we've boiled it down for you, focusing on the key insights and, the stuff that really explains their long-term success. Okay, let's dig in. So at its heart, ADP is basically an outsourced HR department. They do this for over 1 million businesses in 140 countries.
Right. They offer this whole suite of human capital management, HCM, solutions.
Yeah, everything from payroll, tax filing, benefits admin, talent management, compliance stuff. These aren't nice to haves, are they?
No, not at all. They're essential. Complex, too. And definitely non-discretionary for pretty much any business. And they structured it quite cleverly into two main parts. First, there's Employer Services, or ES.
Okay.
This is their cloud-based HCM offering. Software and services for companies of all sizes, really. They got our room powered by ADP for the small guys, 149 employees.
Mm-hmm.
Then ADP Workforce Now for the mid-market, say 50 to almost 1,000 employees. And ADP Vantage HCM for the big ones, over 1,000. This segment, ES, it's about 65% of their revenue last year.
Got it. So that's the main chunk. What's the other part?
The second is the Professional Employer Organization, the PEO. That's ADP TotalSource.
Ah, right.
This is even more comprehensive. It uses the co-employment model. ADP essentially manages the whole HR function for small and medium businesses, payroll, risk, benefits, everything.
The whole thing.
Yeah, and that PEO business, that accounted for about 35% of their revenue in FY24.
Digging into the financials, there's this element that seems almost hidden, but is incredibly powerful for their profits, the float.
Oh, absolutely. The float is huge. It's basically the interest ADP earns on client money they hold temporarily.
Yeah.
Before paying out salaries or remitting taxes.
And we're not talking small change here.
Not at all. It was nearly $1 billion in interest income last year alone.
Yeah.
Just from holding that cash for a short time. It's massive.
$950 million, the sources said. And they moved something like $2.7 trillion in U.S. payroll and taxes back in FY22. Astonishing scale.
Exactly. And because of that, their earnings could be, pretty sensitive to short-term interest rate changes. It's a key factor.
What really jumps out, though, is just how durable this business model seems. It's been around over 75 years.
Right. It's not flashy, but it fulfills this timeless need. Businesses have to pay people correctly. They have to comply with regulations.
And those regulations just keep getting more complex, don't they?
They do. Think about all the changes around COVID-19, for example. That complexity actually makes outsourcing to someone like ADP more appealing. Less risk for the business.
And ADP has managed to stick around by adapting from punch cards.
Yeah, literally punch card machines back in the day, all the way to the cloud-based SaaS platforms they offer now. That shows some real institutional strength, the ability to evolve.
So when you boil it down, ADP's value prop, it feels less about having the absolute slickest software and more about, trust and risk mitigation.
Exactly. They work with thousands of tax agencies just in the U.S., over 8,000, I think.
So clients aren't just buying a tool, they're buying insurance against messing up payroll or taxes, which could be catastrophic.
That's a great way to put it. Insurance against huge financial penalties, legal trouble. It's risk management. And that's what makes the service so incredibly sticky. People don't leave easily.
Okay, so if the core business is essential and sticky, let's talk about the fortress. What really protects ADP from competitors? You mentioned sticky. It sounds like switching costs.
That's precisely it. Their economic moat, their defense, it's built almost entirely on exceptionally high customer switching costs.
And it's not necessarily because their tech is light years ahead.
Not always, no. It's more about the sheer operational friction, the financial cost, the risk to the organization if they try to leave.
Right. Because all that data, the employee history, payroll, taxes, benefits, it's all deeply embedded in ADP's systems.
Deeply embedded. And the numbers back this up. Their client revenue retention rate, consistently over 90%. It hit 92% recently.
92%, wow.
And that's been the case for over a decade. So clients stick around. The average tenure is something like 10 years Employer Services, maybe 7 in PEO. It's impressive.
It really paints a picture. I mean, imagine you're running HR for a, say, 300 employee company using ADP Workforce Now.
Okay.
and you think, maybe we should switch providers. The project.
So yeah.
It's just monumental, isn't it?
Oh, it's a beast. You've got to securely get years of sensitive data out, then configure a whole new system to handle complex federal, state, local labor laws.
Don't forget integrating it with accounting, ERP systems.
Right. And then you have to retrain the entire workforce on a new system, all while making sure absolutely nothing goes wrong with payroll or tax payments in the meantime.
The potential for disaster is huge. And for that HR director, the personal career risk, if they mess up.
Exactly. So unless ADP is really failing them, the path of least resistance, the most rational choice, is just to stay put. That inertia, that's the moat.
So this moat seems pretty solid. Is it getting stronger, weaker? What's the trajectory?
It seems stable, maybe even widening slightly. That long track record of 90% plus retention is strong evidence of stability. And while market share numbers can be tricky, ADP is consistently shown as a leader, maybe holding around 23-24% of the HR and payroll software market.
And it widens how? By selling more stuff.
Pretty much. Cross-selling.
Yeah.
Once they have you for payroll, they try to sell you benefits administration, time and attendance, talent management. Each extra module makes them more integrated, harder to rip out.
Deeper integration equals more friction.
Exactly. Plus, strategic acquisitions, like buying workforce software recently, are specifically designed to add capabilities and, well, widen that moat.
But no fortress is truly unbreachable, right? There must be challenges.
There are, especially at the higher end of the market, the big enterprise clients.
Who's causing trouble there?
Companies like Workday, Oracle, SAP, they're cloud native, often seen as more agile. You see them ranked as leaders in things like the Gartner Magic Quadrant reports.
And they are winning some deals against ADP.
The evidence suggests yes, particularly in that large enterprise space. ADP's strength remains dominant in the small and mid-sized market, though, and they're not standing still. They spent, what, $1.3 billion on R&D last year?
A huge number, clearly trying to defend their turf.
Definitely. But this leads to a really interesting paradox when you look at what customers and employees actually say.
Oh, what's the paradox?
Well, on the surface, review sites show high ratings, like 4.2 to 4.5 out of 5 stars, generally. For their small business product, RUN, they often get ranked as a leader.
Sounds pretty good.
It does. But then you dig into the actual written comments, the qualitative stuff, and you see this persistent pattern of complaints.
Like what?
Things like poor customer service, slow responses, technical glitches, the user interface being clunky sometimes, and lack of clear pricing. Someone summed it up perfectly. Great software, terrible support.
Huh. Great software, terrible support. That really captures it. So high ratings overall, but grumbling underneath.
Exactly. Which makes you wonder.
Yeah, it makes me wonder if that strong retention, that moat, isn't built just on customer love, but maybe more on, well, customer entrapment.
That's a strong way to put it, but yeah. High switching costs are doing the heavy lifting, perhaps more than actual customer delight.
Which feels like a hidden vulnerability, doesn't it? If someone could solve that switching pain point.
It opens the door. Definitely a latent risk. And the employee view is kind of similar, polarized.
How so?
You don't get a sense of one single ADP culture. It seems to vary a lot by team or manager. Some ex-employees call it rewarding, others horrible or toxic.
What are the common themes?
Positives are often good pay, benefits, chances for advancement. Criticisms frequently mention favoritism, a high-pressure sales environment, maybe leadership not really listening.
And weren't there some allegations a few years back about them encouraging positive Glassdoor reviews?
Yes, back in 2018. Allegations of internal contests for positive reviews, which does make you question how genuine some of that overwhelmingly positive sentiment might be.
Okay, so inconsistent culture, potential service issues. How does that connect back to the business risk?
Well, if you've got high turnover in critical customer service roles, that can directly impact the customer experience, right?
Sure. Bad service erodes trust.
Exactly. And for a business like ADP, whose model is fundamentally built on reliability and trust, slowly eroding that trust, that's a significant long-term danger. It could chip away at the foundation.
All right, let's shift gears a bit. What about the people running the show? Leadership, capital allocation. How does ADP stack up there?
Actually, this seems to be a real strength. Leadership and capital allocation look pretty exemplary, very owner-oriented.
Okay.
The CEO, Maria Black, she's a company lifer, started as a sales associate way back in 1996.
Wow, really worked her way up.
Yeah, held numerous leadership roles. So she has this incredibly deep, ground-level understanding of the business. Her focus seems very clear. Strong sales, client satisfaction, expanding margins, and returning capital to shareholders consistently.
And that capital return piece, how do they approach allocating their cash?
They're very disciplined about it. They talk about 3 core pillars.
Okay, what are they?
Pillar 1, reinvest in the core business. That's top priority. Maintaining the moat, innovation. That $1.3 billion in R&D we mentioned fits here. Funding platforms like Lyric HCM.
Makes sense. Keep the engine running.
Pillar 2, strategic M&A. Mergers and acquisitions. But thoughtfully done, usually to add capabilities that make them stickier. Things like Global Cash Card, WorkMarket, Celergo, and that recent big one, Workforce Software.
Logical extensions, not random bets.
Exactly. And pillar 3, the final one, shareholder returns. After funding growth and strategic deals, the excess cash goes back to shareholders.
And they're famous for their dividend, right?
Oh, yeah. ADP is a dividend aristocrat and a dividend king. That means they've increased their dividend for, wait for it, 50 consecutive years as of May 2025.
50 years. That's incredible. That signals real long-term financial health.
Absolutely. They target a payout ratio of about 55-60% of earnings, so it's sustainable. And they consistently buy back shares, too, reducing the count by maybe 1% a year over the last decade. Last year, they returned almost $3.5 billion to shareholders between dividends and buybacks.
So, strong leadership, rational capital use. What about the overall financial picture? Resilience.
Immense strength, consistency, resilience. It's like the quintessential earnings machine.
Because those services are non-discretionary recurring.
Exactly. It makes the model famously recession-resistant. Get this. They actually grew earnings per share right through the Great Recession of 08-09. Very few companies manage that.
That is impressive. What do the key numbers look like over, say, the last decade?
Pretty stellar. Revenue has grown every single year for the past 10, from around $11 billion in FY15 to over $19 billion in FY24.
Consistent top-line growth and profitability.
Return on invested capital, ROIC, is exceptionally high. Recently, it's been over 50%.
50% ROIC, that's huge. That screams wide moat business, doesn't it?
It's probably the clearest single number showing a superior business with strong defenses. For every dollar they invest, they generate over 50 cents in operating profit annually. Phenomenal.
And the quality of those earnings, is it real cash?
Very high quality. Their free cash flow conversion, how much net income turns into actual free cash flow, is consistently over 100%. So the accounting earnings are very real.
And the balance sheet, debt.
Fortress. Very low debt. Their net debt to EBITDA ratio is tiny, like 0.26x. And they have a stellar AA credit rating. Lots of financial safety margin there.
Okay, so financially strong, resilient, great returns on capital. It all sounds amazing, which inevitably leads to the question, what's the price? Is it expensive?
The price to value question. Yes. And the analysis suggests the market definitely recognizes ADP's quality.
What are the multiples telling us?
Right now, the price to earnings ratio, PE, is around 31. Price to free cash flow is about 27.
And how does that compare historically for ADP?
It's pretty much in line, maybe slightly above its recent history. The 5-year average PE is just under 30. So today's multiples suggest, well, a full valuation, maybe even demanding.
So for you, the listener, thinking about this, the current price seems fair, but maybe not cheap.
I'd say that's right. Fair, but demanding. An investment now isn't really a bet on the valuation multiple going up.
It's more a bet on the business itself, just continuing to compound its value over time.
Exactly. It's the price you pay to own a piece of a truly durable, profitable franchise. You're buying the quality and hoping it keeps compounding.
Okay, let's talk growth then. If you're paying that price, where does future growth come from?
Well, it's not expected to be, explosive growth, but there's a clear engine. The main driver is this strategic shift they're making.
From just payroll
to being a fully integrated end-to-end HCM platform partner. They're doing this mainly 2 ways.
Which are?
First, cross-selling. They have this huge captive audience, over 1 million clients. They're trying to sell them more services beyond basic payroll benefits, talent management, higher margin stuff.
Leveraging the existing relationships. Makes sense.
Second is innovation. New platforms like Lyric HCM, AI tools like ADP Assist. The goal is to make their whole ecosystem more valuable, stickier, harder to leave.
And the overall market for HCM is growing too, right?
Yeah, there's a decent tailwind. The HCM market itself is projected to grow somewhere around 8-9% per year. So ADP has that wind at its back too.
Okay, so steady growth potential. But what about the risks? We touched on some vulnerabilities, but what are the big long-term threats?
There are definitely genuine risks.
Yeah.
Number one is probably technological disruption.
Those agile competitors again. Workday, Paycom.
Exactly. Newer cloud-native platforms might just prove fundamentally better over time. If ADP's R&D can't keep pace, that could seriously erode the switching cost moat.
That seems like a constant battle. What else?
Number 2, a catastrophic cybersecurity breach. ADP holds incredibly sensitive data for, 1 in 6 U.S. workers.
That's a terrifying amount of sensitive data. They must be a huge target.
A prime target. A major breach wouldn't just be bad, it could be an existential blow. It would shatter client trust, leading to massive legal costs, reputational ruin. This is maybe the biggest black swan risk, the one that could come out of nowhere and be devastating.
A true nightmare scenario. Any other major risks?
Well, there's the highly improbable but theoretical risk of radical regulatory simplification.
Like if the U.S. tax code suddenly became super simple overnight.
Oh, yeah, exactly. If tax and labor laws became dramatically simpler, the need for ADP's specialized compliance services could diminish. But let's be honest, that feels pretty unlikely.
Agreed. Okay, so disruption, cyber attack, maybe simplification. Now let's try some second-level thinking. What's the market generally think about ADP, and how might our analysis differ?
The general market consensus seems to be a pretty clear hold, meaning the market sees ADP as, a high-quality, stable, reliable blue chip, but maybe a bit mature, modest growth, and already fully valued for those characteristics. Not much upside seen from here.
Okay, that's the consensus. How does the deep dive perspective contrast with that?
Well, I think this analysis puts much more weight on the durability and the compounding power of the business over, a multi-decade horizon.
So looking longer term than the market typically does.
Right. The market might be focused on next quarter's growth rate, but a long-term owner should be focused on the near certainty that ADP will be significantly larger and more profitable 10, 20 years from now.
It sounds like the market might be pricing it like a bond, stable, reliable yield.
While maybe underestimating the equity aspect, the fact that it's a high ROIC business run by good capital allocators. They can reinvest cash back into the business at those high rates, which should compound intrinsic value faster than maybe the market expects.
Interesting. So the market sees stability, we see compounding potential on top of that stability.
Things like that.
All right, time for our final challenge, the red team challenge. Let's invert the bull case. The whole positive view rests heavily on that switching cost moat being basically invincible.
Right. It's the foundation.
So the challenge is, what if that moat is actually more brittle than it looks? What if it's already being chipped away at?
Okay, how could that happen? The inversion scenario starts with that tolerated, not loved customer relationship we talked about. That's the vulnerability.
The great software, terrible support paradox.
Exactly. Now imagine a competitor, well-funded, technologically savvy, maybe one of those Gartner leaders like Workday or Oracle, decides to weaponize the switching process itself.
Weaponize switching? How?
They could invest heavily, develop a near seamless, maybe AI-driven data migration tool, deploy a dedicated white-glove onboarding team whose only job is to make switching away from ADP practically painless.
Eliminate the friction.
Eliminate the friction that currently traps ADP clients.
Wow. And if they paired that frictionless switching with a genuinely better product and maybe a competitive price,
the impact could be devastating for ADP. That 90% plus retention rate, the bedrock, it could start to slip, maybe down to 88%, then 85%.
Which would completely shatter the investment story.
Totally. It breaks the stable compounder narrative. The market reaction would likely be severe, a big derating of the valuation multiple.
So the mistake, the thing the red team flags, is potentially paying a premium growth multiple for a business just as its core competitive advantage starts to crumble, misjudging the moat's durability.
That's the nightmare scenario for an investor, paying for yesterday's dominance just as tomorrow's decline begins.
So there we have it, ADP, a company with really undeniable strengths, that durable model, the formidable moat, strong financials, rational management.
But also those quiet vulnerabilities. The high valuation, the constant threat of tech disruption, that service paradox, and the ever-present black swan risk of a major cyber attack.
Is a fascinating balance.
It really is. And it leaves you, the listener, with some things to think about. What really stands out to you about how ADP balances that stability with the quiet fragility in its customer relationships?
Yeah. And how do you value a business like this, one that offers such reliable returns today, but always faces that potential for radical disruption down the road?
Lots to mull over.
Indeed. Thank you for joining us on this deep dive into ADP. We hope it sparks your own thinking and encourages you to keep exploring these complex, fascinating businesses.